If oil suddenly becomes expensive enough, the real damage does not begin at the gas station. It begins inside every paper. Promise that was priced as if energy would stay cheap, inflation would stay tame, and money would stay easy. That is the first thing I would tell you. The second thing is even more important. Most investors think they get hurt in a crisis because they failed to predict the event. I do not think that is the true failure. The true failure is usually structural. They built a portfolio for a peaceful world. They built a retirement plan for falling rates. They built a life around paper claims whose value depended on calm input costs, cooperative central banks, and the public continuing to believe that inflation was a temporary inconvenience rather than a regime change. Then energy reprices, and suddenly the entire architecture starts confessing what it always was. That is what moments like this really do. They do not create weakness from nothing. They reveal which assets, which businesses, which balance sheets, and which households were only stable under the old price of energy. That is why I do not think this story is mainly about gold and silver. It is not even mainly about Iran. It is about what happens when the price of the physical world rises high enough to challenge the price of the financial world. And once those two prices begin fighting, ordinary investors discover very quickly whether they own protection or merely own promises. Your source document circles this idea in its own way. It ties the current Middle East conflict to the 1973 oil shock, then argues that energy disruption, inflation, paper, asset weakness, and hard asset strength form the real pattern investors should be studying. Follow cite Fayturn 59 file 0 Fay, that is exactly the right skeleton. I just want to strip away the promotional language and rebuild the underlying logic into something sharper. I want you to picture modern finance as a city built on three assumptions. Energy will remain available enough. Money will remain affordable enough. Confidence will remain intact enough. As long as those three assumptions hold, paper wealth looks civilized. Stocks trade at heroic multiples. Long-duration stories stay alive. Bonds pretend they are safe. Retirement accounts appear larger. Savings feel like patience. And the whole country gets lulled into believing that valuation is reality. Then one of the assumptions breaks. Not all three. You only need one. In 1973, the break came through oil. Not because oil itself is mystical, because oil sits inside transport, food, plastics, manufacturing, logistics, heating, fertilizer, and everything else modern life insists on calling ordinary. When the cost of that input explodes, it does not merely make driving annoying. It rewrites the price of everything resting above it. That is why energy shocks are so brutal. They are not narrow, they are systemic. The source document makes this point with the 1973 embargo. It says oil went from roughly $3 to $12 a barrel. Fuel shortages appeared, gas stations closed, Americans lined up for hours, and the cost of living jumped sharply as food and transport costs rose with energy. Follow cite Fayturn 59 file 0 Fay. That is the visible story. But the deeper story is what happened to portfolios. The average person imagines a crisis like that as a bad week or a bad year. That is because he still thinks in headlines. The investor who understands structure thinks in regime changes. A regime change is different. It means the assumptions underneath your entire portfolio have shifted. Rates behave differently. Inflation behaves differently. Consumer behavior behaves differently. Government policy behaves differently. The things that looked prudent a year ago become traps. The things that looked old-fashioned become lifeboats. The source document says the 1973 to early 1980s period destroyed paper wealth in real terms, and that many stock investors did not truly recover their purchasing power for years. Once inflation was taken seriously, Follow cite Fayturn 59 file 0 Fay, that distinction matters. Nominal recovery is not real recovery. If the number on your statement goes back up while the money itself buys dramatically less, you did not really win. You merely watched the measuring stick shrink while you congratulated the chart. This is why inflation is so misunderstood. It is not simply higher prices. It is a weapon against fixed claims. A solvent poured over savings, bonds, pensions, salaries, and all the lazy assumptions of the paper world. That is why high inflation and energy shocks so often arrive together as political and financial trauma. They tell the same truth from different directions. The real economy is repricing, and the financial economy no longer gets to pretend otherwise. The source document then pivots to gold and silver and points out what happened in that earlier regime. It says gold rose dramatically after the end of its fixed peg. and that silver also exploded higher as investors searched for hard assets during a period of inflation, monetary distrust, and geopolitical stress. Fay file site Fayturn 59 file 0 Fay. That is not a magic trick. It is not because metal is holy. It is because a hard asset behaves differently when the paper around it begins losing credibility. This is one of the oldest truths in all of finance. Paper assets do best when trust is high. Liquidity is easy, and the system can keep making future promises at low cost. Hard assets do best when the public begins doubting whether the system can make those promises without debasing the unit of account itself. That is the real contest, not gold versus stocks in a vacuum, trust versus escape from trust. Now let me make this less sentimental and more precise. Hard assets are not automatically good. They have no feelings and no moral superiority. They are simply different. They cannot be printed. They cannot be diluted by decree. They do not require an earnings conference call to justify their existence. They do not need a central bank to lower rates so their valuation can still look reasonable. They just are. And when the paper world becomes unstable enough, just are becomes a very valuable characteristic. The source document summarizes this in a rough way by saying, hard assets preserved or increased wealth while cash, bonds, and many salaries were damaged during the energy inflation spiral. Fayfula cite Fayturn 59 file 0 Fay. That is directionally correct. But I want to be even more specific. Cash is not always trash. Cash can be a weapon when panic produces bargains. Bonds are not always doomed. Strong balance sheets and the right duration at the right price can be intelligent. Stocks are not all one thing. Some businesses survive and even gain power in inflationary stress because they have pricing power, hard assets, or leverage to higher nominal replacement values. The real line is not buy metal, sell everything else. The real line is this: when energy reprices violently, every asset must be re-asked one question. What does this own, and what does it owe in a world where physical inputs are suddenly more expensive and money may not get easier when you most want it to? That is the adult question, and it is why I dislike shallow crisis commentary. It teaches people to chase symbols rather than interrogate balance sheets. The source document spends a great deal of time saying governments are always late. It describes Nixon's weak symbolic responses in the 1970s, later institutional efforts like the Department of Energy and the Strategic Petroleum Reserve, and then compares those reactions with today's emergency reserve releases and official language meant to calm markets. Fayfula cite Fayturn 59 file 0 Fay. That is one of the strongest ideas in the whole file. Governments are almost always late because governments are built to react to visible pain, not to anticipate the invisible compounding of structural risk. By the time a politician says everything is under control, the serious money has already repriced the possibility that it is not. That is why I tell people never to wait for government reassurance before protecting themselves. The state may eventually stabilize the situation, it may not. But even when it does intervene, the intervention itself often changes the value of cash, debt, savings, and long-duration paper claims. That is what ordinary people miss. They think intervention is neutral. It is never neutral. Emergency reserve releases, fiscal support, price controls, new subsidies, money printing, rate caps, war spending, industrial support, all of it helps some assets and hurts others. All of it rearranges the field. And once the field is rearranged, the old portfolio map can become worse than useless. It can become an emotional liability. Now let us talk about complacency, because this is where the real damage usually begins. Your source document says something very important near the end. It points out that after the 1970s, the United States eventually developed fracking and greater domestic energy flexibility, and that as energy fears faded, investors became complacent. Again, it then argues that before the recent escalation, cheap oil and open shipping lanes had once more created the assumption that the underlying system would remain cooperative indefinitely. Fay file cite Fayturn 59 file 0 Fay. That is exactly how cycles restart, not through ignorance of history in the abstract, through comfort. When the last shock fades far enough into the background, people no longer see energy as strategy. They see it as scenery. That is when portfolios get sloppy. That is when consumer habits become fragile. That is when businesses stop stress, testing input costs properly. That is when entire markets begin trading as though the physical world has become subordinate to software liquidity and optimism. And that is when I become interested, because complacency is not just a mood, it is accumulated unpreparedness. A person holding too much long-duration paper in a world of rising energy costs is not merely unlucky. He is holding a portfolio that forgot what the real economy can still do to the financial one. That is the real mistake. Now, I want to talk about gold and silver in a much more disciplined way than the source does. The source is excited about them. It cites large upside forecasts, references draining inventories, and uses them as the central hard asset response to the current crisis. Fay File Cite Fay Turn 59 File 0 Fay Fine. The enthusiasm is understandable, but enthusiasm alone is a terrible portfolio manager. Here is the correct framework. Gold is not a business. Silver is not a business. They do not compound capital internally the way a great company can. They do not raise margins because management got smarter. They do not buy back shares. They do not innovate. What they do is something else. They sit outside the promise chain. That is their real role. And that role becomes more valuable when trust in paper promises weakens, when inflation volatility rises, when central banks look cornered, when geopolitical shocks hit energy, and when investors begin worrying that the old stock. Bond Playbook was built for a calmer monetary climate than the one now emerging. That is why gold matters. Not because it is exciting, because it is stubborn. Silver is more complicated. It behaves partly like monetary insurance and partly like an industrial metal with cyclical demand. That dual nature creates more upside in certain moments and more volatility in many others. The source document says silver historically outperformed during some hard asset bull markets, but also warns that it is far more volatile and requires better risk management. Fay File Cite Fay Turn 59 File 0 Fay, that is right. Silver is what happens when you combine monetary fear with industrial demand and then pour gasoline on the psychology. It can be powerful. It can also be savage. That is why people who use it as a substitute for discipline often get hurt. This is true in every cycle. A good thesis plus weak position sizing equals a bad outcome. That is not the metal S fault. It is the owner. This is why I always tell people to separate asset role from emotional fantasy. Gold S role is not to make you feel brilliant every month. Its role is to sit there and be nobody S promise in a world full of promises. Silver S role is not to turn your retirement into a casino ticket. Its role is to offer a more volatile version of hard asset exposure that may do very well if the cycle evolves in that direction. Those are different things. Now let us talk about the ratio logic the source mentions. It says the gold-oil ratio can serve as an early warning signal because gold may move ahead of the broader public realization that an energy crisis is serious. It describes gold as a kind of thermometer and oil as the patient. Fay File Cite Fay Turn 59 File 0 Fay. That is an interesting metaphor. And the deeper point underneath it is worthwhile. When one hard asset starts rising strongly before another input cost fully reprices, it can be signaling that sophisticated money is preparing for an inflation or credibility problem before the public data fully catches up. That does not make any single ratio a magic oracle. Nothing in markets is that kind. But it does remind you to watch relationships, not just isolated prices, because the financial world hides regime change inside relationships first: energy versus money, gold versus real yields, dollar versus oil, hard assets versus long-duration paper. Those relationships tell you more than one screaming headline ever will. The source also talks about watching COMEX inventory and related market plumbing. I think that instinct is good, even if many viewers will not follow it with enough nuance. Fay File Cite Fay Turn 59 File 0 Fay. What matters is not becoming a conspiracy hobbyist. What matters is becoming structurally literate. Where is the inventory? How much is registered? What is being drawn? Who needs delivery? How stressed are futures markets? How are miners behaving relative to spot? What is the term structure telling you? This is how adults read a precious metals cycle. Not red candle means thesis dead. Not green candle means civilization ending. Structure. Always structure. Now let us pull 1973 and today together without pretending they are identical. Your source document spends much of its middle section drawing the parallel directly. Middle East conflict, a threatened or real oil supply disruption, higher inflation pressure, stock market vulnerability, and the possibility that investors with hard assets and preparation fare better than those who remain complacent. Fay File Cite Fay Turn 59 File 0 Fay. That is directionally right. But we should also be honest. History rhymes more often than it repeats. The United States is a bigger energy producer. Now, markets are more financialized. Central banks are more interventionist. supply chains are more global. The AI and tech concentration inside equity indices makes today's stock market structurally different from 1973, and yet the core pattern remains uncomfortably similar. A geopolitical shock strikes energy. Inflation expectations begin rising. Rate cuts become less certain. Paper assets that depended on easier money become more fragile. Hard assets and real assets suddenly look less quaint and more strategic. That is the rhyme. And it is enough you do not need identical costumes to recognize the old choreography. Now let me say something about retirement accounts, because the source opens by warning even people who only have stock-heavy 401k as that this may be the biggest wealth event of their lifetime. Fay-Filocyte Fay-Turn 59 File 0 Fay. The phrase is dramatic, but the underlying warning deserves respect. Most ordinary people do not have a portfolio. They have a concentration, broad U.S. equities, some target date wrappers, some bonds, maybe cash. That is fine in certain regimes. But a regime built on low inflation, falling rates, and constant policy support is not the only regime history offers. If energy shocks and inflationary pressure begin challenging that setup, then the ordinary saver needs to ask a harder question. What exactly do I own that benefits when real-world scarcity reprices upward? Not because you should panic, sell everything and go live in a bunker lined with bullion, because a portfolio built for one climate should at least be interrogated when the climate begins changing. That is just adult stewardship. The source frames this as a call to prepare rather than panic, and I think that is the right instinct beneath the marketing. Fay-Filocyte Fay-Turn 59 File 0 Fay. Preparation is the only civilized answer to crisis. Panic is what transfers wealth away from the public toward whoever remained liquid, calm, and structurally aligned. That is the whole pattern. In the 1970s, the people who understood what inflation and energy shock were doing to paper wealth had a chance to protect themselves, and sometimes do far better than the crowd. In every later crisis, the same basic law held the people who could distinguish signal from noise and structure from storyline, usually exited with much more than the people who stayed inside the comforting mainstream narrative one cycle too long. Now let me tell you what I think the real playbook is. Not the promotional version, the real one. First, understand the regime, not the headline, the regime. Are we in a period where money is likely getting easier, inflation is falling, and long-duration paper can breathe? Or are we entering a period where energy scarcity, geopolitical stress, and sticky inflation pressure make financial assets more vulnerable and real assets more relevant? That is the first question. Second, understand your own fragility. How dependent is your life on cheap fuel, low rates, stable job conditions, and markets behaving? Well, if the answer is very, then your problem is not only asset allocation, it is structure. Third, own some things that do not depend entirely on central bankers, management guidance, and public confidence. That can mean hard assets. It can mean real assets. It can mean businesses with pricing power and tangible value. It can mean lower leverage. Different households will express it differently. But the principle is the same. Do not let all your future depend on one regime continuing forever. Fourth, keep liquidity. Because the greatest mistake in every crisis is that people either become too complacent before it or too panicked during it. Liquidity is what allows you to avoid both. Liquidity lets you endure. Liquidity lets you choose. Liquidity lets you buy when other people are forced to sell. That is why I have always respected cash more than fashionable people do. Cash is not merely a low-return asset, it is unspent optionality. Fifth, train your own psychology, because none of this matters if your behavior fails when the moment finally arrives. The source warns directly against panic. And that may be the wisest part of the whole piece. Fay-Filocyte Fay-Turn 59 File 0 Fay. Yes, do not panic. Do not become hysterical. Do not turn a macro thesis into emotional flailing. But also do not become one of those polished investors who uses stay calm as an excuse to remain completely structurally exposed. Calm is not denial. Calm is preparation without drama. That is what adults do. Now let me leave you with the image I think matters most. Imagine two towns sitting beside the same fuel line. One town treats the line as permanent. It builds everything on the assumption that deliveries will always arrive on time, prices will stay tolerable, and the system will somehow absorb any disturbance without changing the local way of life. The other town understands that cheap energy is not a law of nature. It keeps reserves, it owns some hard assets, It avoids overbuilding on fragile assumptions. It knows where its vulnerabilities are. When the line gets disrupted, the first town calls it a shocking crisis, the second calls it a repricing. That is the whole difference, and that is the contract I would make with my future self. I will not wait for the crowd to recognize an energy repricing before I ask what it means for the paper claims in my life. I will not confuse nominal recovery with real purchasing, power recovery. I will respect hard assets without worshiping them. I will respect paper assets without pretending they are immune to a change in regime. I will own some things that sit outside the promise chain. I will hold enough liquidity that panic belongs to other people. Not to me. I will study relationships, not just headlines. I will remember that governments are always late, markets are always forward, and complacency is usually the hidden fuel that lets a crisis burn so far, and I will remember that the greatest wealth events of a lifetime are rarely created when everything is easy. They are created when the old assumptions crack, the crowd freezes, and the people who already understood the structure begin quietly taking possession of what the unprepared can no longer hold. That is the pattern, that is the real playbook. And that is why the investor who learns to read an energy shock as a monetary and balance sheet event, not just a political event, has a chance to do something much more valuable than panic. He has a chance to position himself on the side of the transfer instead of on the side of the destruction.